Hi everyone. Welcome to today's webinar brought to you by IronFX. Right, today we're going to be looking at trading interest rate announcements. All right, before we begin today's webinar, please take note of the disclaimer and the risk warning. Right, the information is not considered as investment advice or investment recommendation, but instead is marketing communication. And take note of the risk warning as well that all the products here are traded on margin and carry a high level of risk, and it is possible to lose all your capital. All right. My name is Ketan Ramachandra, and this webinar series is brought to you the special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years 2019, 2020, and 2021. Right. So here's the agenda for today. Right. We'll start off by looking at the basics of what are interest rates and who controls them, right? And how do interest rates, and then we'll move on to how interest rate decisions impact financial markets. And of course, how can we trade them and what are the resources available to us to help us improve our decision-making process when it comes to trading these events. Right. Now, and it's let's just take a look at its most simplest form. What are interest rates and who controls them? Right. So basically, interest rates are bank rates that are charged to domestic banks to borrow money. Now, these banks then provide loans to institutions, businesses, households, individuals at a higher interest rate to earn income on the spread, otherwise known as net interest margin. Right. So net interest margin or NIM is one of the primary ways that banks uh, make money, right? That's how they are profitable, right? By receiving money from a central bank, right? By borrowing from a central bank, they then loan out the money to other institutions, businesses at a slightly higher interest rate to earn income on the spread. Now, what are the type of examples of loans that are available, right? Many of you should may be familiar with this, right? We have business loans, mortgage loans, personal loans, as well as credit loans as well. Now, a nation's central bank sets the interest rates to implement or signal its monetary policy stance. Either it's going to be hawkish, dovish, or in some cases even neutral. Right, so a hawkish central bank is one that is looking to raise interest rates or is already in the process of hiking interest rates. Now, and conversely, a central bank that is dovish is one that is looking to cut interest rates or is in the process of rate cycling sequence, rate cutting cycle. Right. So remember, when a central bank is deemed to be hawkish, they are looking to raise interest rates or they're already in the cycle of raising rates. Conversely, when a central bank is deemed to be dovish, they are looking to cut rates or they are in the cycle of rate cutting at the present moment. Now, which are the key central banks around the world, right? Many of you will be familiar with this. The most influential central bank in the world is going to be from the United States, and that is the Federal Reserve, right? And we also have, of course, key central banks from Europe, the European Central Bank, Bank of Canada, Bank of England, Bank of Japan, the RBA, RBNZ, and the Swiss National Bank as well. Right, these are some of the key major central banks globally, and these are the ones that can have a huge impact on their respective currencies when they embark on a rate decision outcome. Now, how do interest rates decisions impact markets, right? Well, before we get to that, we'll take a look at the most influential and prominent central bank, and that is the Federal Reserve, otherwise known as the Fed. Now, the Fed's objectives are with maintaining a certain level of stability in US financial markets by promoting economic and employment growth through the implementation of changes to interest rates. Now, central banks have limited tools at their disposal, and one of the key tools that they have is to raise or lower interest rates. They can also embark on such policies such as quantitative easing, otherwise known as printing money, right? Or quantitative tightening as well. So they have limited disposals, limited tools at their disposals, and one of the primary ways that they try to maintain stability within the financial market and to spur employment growth or economic activity is via interest rate changes. Now, from the perspective of the Fed, there are two types of rates that they can set. They have the target interest rates and the discount rate. Now, the target interest rate, otherwise known as the Fed funds rates, are the ones that we are primarily looking at. Now, these are rates at which banks lend to each other overnight in order to maintain reserve requirements. And the discount rate is the rate at which banks can borrow directly from the central bank, which is the Fed. So, which banks are we talking about? This could be banks such as JP Morgan, Bank of America, Morgan Stanley, and so on and so forth, that would borrow that would borrow money or take on loans from the Federal Reserve, and then in turn, pass that provide loans to U.S. institutions, businesses, households, and so on and so forth. Now, in its simplest form, right? When the Fed raises interest rates, it increases the cost of borrowing. This increases cost of borrowing for institutions, households, and individuals, making both credit and investment more expensive. Now, this is typically done to slow an overheated economy, uh, which is probably experiencing high inflation as well. Conversely, if the Fed is lowering rates, it makes borrowing cheaper for everyone, which encourages spending on credit and investment, and this is usually done to stimulate a stagnant or a slowing economy. Now, what are examples of overheated economies? Right, in over the last 25 years, these are the most recent examples. Right, basically, an overheated economy is when we see asset bubbles materialize. So, in between 1999 and 2001, we had the dot-com bubble. In 2007 to 2008, we had the real estate mortgages. And in 2022, we had the high inflationary environment. These are all examples, various examples of overheated economy related to high inflationary pressures, related to uh, a bubble in real estate mortgages, or a bubble in US stocks as well. This was the 2001 dot-com bubble. Now, you can see here the brief history of how Fed funds rates have been set since 2014 to 2025. This is just over the last 25 years. And we can see as inflation was rising rapidly in 2022, or even before that in 2021, we already saw inflation start to rise above the Fed's target of 2%, right? And that led to the Fed raising interest rates aggressively. This hike that we saw from March of 2022 all the way till the middle of 2023 was one of the most fastest pace that the Fed had embarked on. Right, they rose rates from which were as low as 0.25% to as high as 5.5%. Right, and they kept rates elevated from mid 2023 all the way till the end of third quarter of last year. Remember, from September of last year onwards, right, that's when the Fed embarked on a rate cutting cycle, where they made three consecutive rate cuts uh, at the final three meetings of 2024. Right, so we can see here, right, how central banks are going to raise rates, for example, here in 2022 as inflationary pressures started to take control here, started to seep into the economy, and also in 2017 to 2019, right, as we were in a pretty good economic period, right? They were trying to slow down an overheated economy as well, and it did that by trying to raise interest rates as well. And of course, we had the pandemic lockdowns in March of 2020, where we saw interest rates being cut aggressively. Right, so at the present moment, right, at its most recent meeting in May, right, the Federal Reserve kept the Fed funds rate on hold at 4.25 to 4.5%. So take note for the Fed funds rate, it's a target range between 4.25 and 4.5%, but typically most people focus on the upper band of that range, right? So they've cut about 100 basis points. So basically between 2023 and 2024, over the 12-month period, the Fed funds rate stood at 5.25 to 5.5%. And they've made a 100 basis points reduction over the three meetings, bringing it down now to 4.25 to 4.5%. Right, as you can see here now let's move on over to US inflation, consumer inflation. Right, and on the left, we have the chart for headline CPI, and on the right, we have the chart for core CPI. And we can see here, even as early as April and May of 2021, inflation had already started to rise. Remember, inflation was already rising well before 2022, right? 2022 was March of 2022. That was when the Fed started to raise interest rates to try and tackle rising inflation. But we can see here, right, both headline CPI and core CPI were already rising quite rapidly in the middle of 2021 and climbing above the Fed's target of 2%. Remember, the Fed has a target range for inflation, and that stands at an annualized rate of 2%. And very clearly, by middle of 2021, both headline and core CPI had already accelerated and risen above that target level of 2%. So in a sense, you could say the Fed had a delayed reaction when it came to raising interest rates in 2022. They only started raising rates in March of 2022, when in fact they should have started raising rates at least in the third quarter of 2021, or maybe as late as the fourth quarter of 2021. But instead, they waited till the end of the first quarter of 2022 before starting to raise interest rates, because at that time they had assumed uh, that inflation was transitory, hence they were reluctant to raise interest rates in 2021. But in hindsight, with the benefit of hindsight, we could see that clearly that assumption or the conclusion or the assessment, sorry, at that point was wrong, right? Inflation wasn't transitory, and we saw it accelerate all the way as high as about 6.7% for headline CPI, and for core CPI, it was as high as about 6.5%. Now, moving over to PPI, which is Producer Price Index, this measures the level of inflation in the wholesale sector, right? And typically, when inflation for this sector rises as well, right, in the wholesale sector, this will eventually get passed on to retailers, right? Remember, when goods producers, services producers, when their cost increases, right, they're naturally not going to absorb that cost. They're going to pass it on to the retailers, and then all of that higher prices flows back into consumer prices, right? Producer prices, if we see producer prices accelerate sharply, which is what we saw in 2021 for both headline and core PPI, that naturally is going to feed back into consumer price indices. So ultimately, the consumer is going to be paying for higher prices as retailers and producers will be looking to maintain their margins, right? No one's working for free. No one's producing goods and services for free, and everyone needs to maintain a certain level of margins, and higher costs all eventually get passed on to the retailer, right? And sorry, passed on to the retailer and finally to the consumer. Now, how can we trade interest rate decisions? Coming back to interest rate decisions, we have to keep an eye out for key macroeconomic events, right? Not This may include central bank decisions, right? Changes in interest rates decisions. We also have to look at what is potential deviation from normal monetary policy action, such as central bank interventions. And it's also important in identifying divergence in monetary policy between two central banks, right? When we identify divergence between two central banks, that usually leads to a very uh, what do you call, a large move in that currency pair. So what do I mean by divergence? Well, let's take the example with a very good live example or very recent example in 2022, right? So in 2022, the Fed was aggressively raising interest rates to combat inflation, along with many of the major central banks around the world. However, there was one outlier, and that was the Bank of Japan, right? The Bank of Japan over this period, right, from 2022 through 2024, pretty much kept its key policy rate at negative 0.1% to stimulate its economy, right? So you can see here, we have the Federal Reserve, the most influential central bank in the world, raising interest rates aggressively, while the Bank of Japan, another key central bank, kept its policy rate or its interest rate at negative 0.1%. So this is a good example of divergence between uh, two central banks, right? In this case, for the Fed was raising rates, BOJ kept rates at negative 0.1%, or you could also have a case where central bank A is raising rates aggressively, while central bank B is cutting rates aggressively. So you could be trying to trade that currency pair. So in the case of the Fed and the BOJ, the currencies that are involved are the US dollar and the Japanese yen. So when the Fed is raising rates aggressively, right, it typically would mean demand or the value for the US dollar is going to rise, and conversely, value of the Japanese yen is going to fall. So that means the currency pair dollar yen is going to climb strongly, right? So that's important to identify divergence in monetary policy between two central banks, because that's one of the easiest way to capitalize on a very successful trade. All right, hi Jamilu, good to see you as well. Thanks for tuning in. Right, we're also looking to see changes in inflation growth, right, as we saw here, as inflation started to spike or accelerate aggressively, right, that's going to raise eyebrows at central banks as well, and the Fed is going to likely to raise interest rates to combat inflation. So changes in inflation growth is important, not only to the upside, but to the downside as well, as inflation peaks and starts to decelerate. That's important as well, because that also means central banks are not going to be raising rates aggressively. And you could see that they are going to start to shift their stance with regards to future monetary policy action. It's also important to take note of changes in economic growth as well with regards to GDP, output, PMI reports, non-farm payrolls, which tracks US labor market data, right, and inflation as well. Now, we talked about central bank intervention as well. This is a deviation from normal monetary policy action. Now, the Bank of Japan, as recently, right, over the last 2 to 3 years, intervened in the open currency markets. Now, remember, in 2022, as the Fed was raising rates aggressively, the value of the dollar was rising sharply while the Japanese yen remained weak. So that meant the currency pair dollar yen was going to climb very strongly. Now, there's a benefit for having a weak Japanese yen, and that means Japan's exports are cheaper to the rest of the world, and that would mean there would be higher demand for Japanese exports, right? So that means the export markets for Japan is going to be great, right? As we see a lot of demand, so Japan's going to be exporting a lot of goods and services because their currency is relatively weak compared to the country that is importing them. But on the flip side, a weak Japanese yen makes their imports more expensive, right? So when the Japanese yen was losing its value rapidly, they needed to prop up the value of the yen, and the Bank of Japan typically does that by intervening in the open currency markets, right? So we can see here, right, when an intervention measure or operation is conducted by the Bank of Japan, right, it's not going to be announced uh, to the media beforehand. But once that intervention measure has taken place, right, those actions have taken place, it's going to be reported widely in the mass media, right, the mass financial media, right? So this is not something that you have to subscribe to for special paid service, right? This is going to be reported in most of the major financial news media outlets such as Yahoo Finance, right, CNBC, investing.com, Reuters, so on and so forth, right? But once we get a sniff of central bank intervention, right, it's important to pay attention to it because it can really drive the direction of that currency pair, right? And in this case, it would be the currency pair involved. In this example, would be the dollar yen, right? So we can see here throughout 2022, right, there were various stages at which the Bank of Japan intervened in the open currency markets. And in here, during this process or this operation, what they're doing is to prop up the value of the Japanese yen. They're basically selling their reserve. So Japan's reserve consists of the US dollar and US Treasury bonds. Now, when they sell those the US Treasury bonds, they get US dollars, and then they're selling those dollars uh, into the open foreign exchange market and using the proceeds to buy back the Japanese yen. So when they do that, they're selling dollars, buying back the yen. So that means the Japanese yen is likely to strengthen, and that's was what had happened in the third quarter of 2022. So actually, when you look at 2022 from the perspective of the dollar yen, is a tale of two halves. In the first half, we saw the dollar yen rise rapidly, and then as intervention measures started taking place, we saw the dollar yen reverse course very sharply. So later on, in a little bit, when we move on over to the charts on TradingView, we'll get a good understanding of how monetary policy divergence between two central banks can cause a currency pair to rise rapidly. And then we have a very good example for the same currency pair when a central bank intervention causes abrupt reversal, and we see that currency pair reverse course and drop very sharply. Right? So the Bank of Japan is no stranger to conducting central bank intervention measures in open currency markets. And even in 2024, they embarked on another round of intervention measures, but this one was not as strong, or I would say it's not as impactful as 2022. Right, okay. Now, before we continue, it's also important to understand what is the dollar index, right? The dollar index, otherwise known as the DXY, right, is a basket of currencies that tracks or measures the value of the US dollar versus its peers. Now, the dollar index is also a tradable instrument on the platform as well, right? It's also an instrument that you can trade, but at the same time, we need to understand what this index is consist of, right? The dollar index is not a currency; it's actually a basket of currencies that measures the value of the US dollar versus its peers. Now, the components and weights of this basket is important as well, as we can see here: the euro, Japanese yen, sterling pound, Canadian dollar, Swedish krona, and Swiss franc all make up this basket. You have 6 currencies that make up the dollar index basket. But what's more important is the weightage of each of those individual currencies. Now we can see here, the euro makes up nearly 58% of this basket. The Japanese yen makes up nearly 14%. And then you have sterling pound with 12, Canadian dollar with 9, Swedish krona with 4%, and Swiss franc with 3.6%. So you can see here, the weightage is heavily skewed towards the euro and the Japanese yen. So that means nearly 70% of the basket is made up of the euro and Japanese yen. So what this also tells us is when the dollar index is rising rapidly, right, it means demand for the US dollar is very strong. And that would also mean that the euro is going to be very weak, and Japanese yen is also likely to be equally as weak as well. Remember, because these two components form the largest part of the basket, right? The largest weights of the baskets. So when we see the dollar index rising rapidly, it means the euro is under significant pressure. It also means Japanese yen is also under significant pressure. So that means the currency pair euro USD would be falling, and currency pair dollar yen would be rising. And so if we have very strong market action on the dollar index, and we see the dollar index falling, right? Okay, sorry. If you see the dollar index rising, right? Remember, I started off with strong demand for the dollar, right? If demand for the US dollar is very strong, we're going to see the dollar index rise rapidly. And when we see that, it means the currency pair Euro USD is going to be falling rapidly, while at the same time, the currency pair dollar yen is going to be accelerating or rising sharply as well, right? Now, conversely, if we see the dollar index dropping very rapidly, it means demand for the dollar is very weak, right? Demand for the dollar is weak. And because the basket consists of 58% of the euro, right? That means the euro currency pair now is going to be rising very rapidly. And conversely, the currency pair dollar yen is going to be falling. So take note. Of course, all the other currencies pairs are also going to be impacted as well. But the largest moves are typically going to be seen in the euro, and then after that, the Japanese yen. Remember, the euro makes up 58% of the dollar index basket. So when we see the dollar index rising very rapidly, the euro is likely to be tanking, right? So that means euro USD is falling. And conversely, when dollar index, the value of the dollar index is falling rapidly, that means the currency pair euro USD is going to be rising very sharply, right? So take note of what is actually the dollar index, right? It's not a currency, right? It's basically it's an index that measures the value of the US dollar versus a basket of currencies. And that basket consists of the euro, Japanese yen, sterling pound, Canadian dollar, Swedish krona, Swiss franc, and more importantly, the basket has consists of the euro, which is at 58%, and the yen, which is at 14%. Right, we can see here, right, over the last 12 months or so, right, as inflationary pressures were dropping, right, on the left I have the chart for headline CPI, and on the right I have the chart for core CPI. And you can see here for most parts of over the last 12 months, core CPI remained persistently sticky, hovering between 3.2 and 3.3%, right, for most parts of 2024. However, in the third quarter of 2024, we saw inflationary pressures, headline CPI fall pretty rapidly. We saw headline CPI decelerate, and this raised market expectations of rate cuts. Remember, the Fed only started cutting rates in September. Here, September was the first rate cut where they made a jumbo 50 basis point reduction in the Fed funds rate. So you can see here, as inflationary pressures were decelerating, right, it gave the Fed confidence to move ahead with the first rate cut in September. While although core CPI was relatively stable, we did not see any deceleration in core CPI. But because over this period, we saw headline CPI decelerate, and at the same time, we also saw the US labor market weaken in the third quarter of 2024. All of this led to market expectations of a rate cut, and that moved and then triggered or functioned as a catalyst for the Federal Reserve to make its first move in September. Now, the Fed started to cut in September, November, and December. But by the end of December, we had started to see inflation accelerate, right? Particularly headline CPI started to, headline CPI, yes, started to accelerate from 2.4% to as high as 3% in January of this year. Now, that is why, right, by the time the Fed made its third and final rate cut of 2024, that is why when we came to January, rate cut expectations had sort of diminished, right? We saw inflationary pressures start to accelerate, and we also saw the US labor market start to rebound as well, right? Remember, rising inflation, a resilient labor market doesn't give the Fed much reason to cut aggressively, right? Although they did make aggressive cuts from September to November, right? They made 50 basis point reduction in September, 25 in November, and another 25 in December. But after that, once the US economy stabilized, the labor market uh, stabilized as well. And because we saw inflation starting to increase, the Fed actually rate cut expectations for the Fed actually diminished drastically, and that led to the Fed maintaining rates in 2025. Right, that's why it's important to understand why how inflation is also trending and where the labor market is heading as well. Now, when we look at labor market, right, we have ADP employment report, which tracks the level of job growth in the private sector, and you have the non-farm payrolls, which tracks the number of job growth for both private and government jobs. So AD, non-farm payrolls, along with the unemployment rate, is released and tracked or is tracked and released by the Bureau of Labor Statistics, while ADP is a private company known as Automatic Data Processing, and they track private payroll growth. So although throughout 2024, private payroll growth was pretty steady, right, when we look at it through 2024, however, we can see non-farm payrolls actually grow weaker, although we did not see any jobs being shed over this period, but we did see non-farm payrolls, but the job growth of non-farm payrolls become significantly weaker from May till October. And this is over the same period where roughly over the same period where we saw headline CPI started to decelerate. So when you have a combination of a slowing labor market as highlighted by the non-farm payrolls monthly job gains, and we have a scenario where inflationary pressures are dissipating quite strongly, that gives strong impetus for the Federal Reserve to start cutting rates, right? So that means rate cut expectations were rising, right? Rate cut expectations were rising. Now, in the final quarter of 2024, we can see non-farm payrolls rebound quite strongly, and we also can see inflationary pressures start to reaccelerate, right? And this diminishes rate cut expectations. Now, when we go to the charts, this is all going to be when we put it all together and we look at it on the charts, we can understand that trading interest rate decisions is not about trading at the point of the release of the statement, but rather it's about trading ahead of the statement. Remember, markets are always forward-looking, and if you're actually waiting for the Fed to make its announcement before putting on a trade, right, you're likely to be on the wrong side of that trade. Now, when we get to the charts and trading view, you guys will get a better understanding of what do I mean by that. Now, another good resource to use is or to monitor is the CME FedWatch tool. This is a free website, and it gives us the target rate probabilities for each upcoming meeting. Now, the next Fed meeting is taking place on 18th of June. The current Fed funds rate sits at 4.25% to 4.5%, and it gives us the probabilities of what the Fed is expected to do. So you can see here, for the Fed funds rate to remain unchanged at 4.25 to 4.5%, we have a probability of 98.7%. So that means we already know going into the meeting in about 2 weeks, less than 2 weeks, we know that the Fed is going to keep rates on hold, right? No surprises there. And for the Fed to make a 25 basis point reduction, there's a very slim chance with a probability of just 1.3%, right? So even before the Fed funds, the FOMC meeting concludes, right, we already know what are the probabilities with regards to the outcome. Right, so I'm going to see if I can drop this link in the website, in the chat box here, so you guys can access it easily. Just let me get to that website. Let me get to that page, sorry. Here we go. And also these are the resources, right? I'll drop the resources later on. Actually I might as well just drop it now, right? Since I've dropped the resources for the CME group, right? You can either take a screenshot of this slide, but at the same time for easier access, I'm going to drop the respective links in the chat box as well. Right, there you go, guys. All right, now let's move on to the chart and trading view and let's put this all together, right? Because remember, markets are always forward looking. And if you are actually waiting for the Fed to drop its monetary policy statement and waiting for Chairman Jerome Powell to make his press conference, right? Actually, you're already behind the game. You need to be looking at what is actually happening to key US macroeconomic data. And in the current context, keeping a close eye on US CPI and the labor market is actually driving the Fed's decision-making process. So now let's go back to, now finally let's move on to the slides of trading view and let's take and look at the chart for the dollar index. Right. So now I'm on the daily time frame for the dollar index. Remember, the dollar index is is an index that measures the value of the US dollar versus a basket of currencies. Now we can see here in the third quarter of last year. Oops, hang on. Let me go to the third quarter. Where are we now? Yes, there we go. Let's go back to the third quarter of last year, pretty much. Or let's go look at it at the second half of last year. Right. This is the third quarter. This first box here is Q3. So the first box that we have here is the third quarter of 2024, which was last year. So we can see the dollar index was at a relatively high level of 106. And by the end of September, it dropped down to 100.18. Right. Okay. Now before that, I will mark the FOMC dates as well. This is going to be important, right? So if you go on here to this website, right, the FOMC calendar, this is also has been dropped in the chat box, and we can see the dates for last year. So remember, September was the date when the Fed started to cut rates, right? So 18 September 2024 was when they made the 50 basis point reduction. 7 November, they made a 25 basis point reduction. And December 18, they made another 25 basis point reduction. So we'll be looking at key dates, 18 September, 7 November, 18 December. So 18, 7, 18. Yeah, 18, 7, 18. Let's go to 18 of September, which is this vertical candle. We're going to be putting it in maroon. And we'll be looking at 7th November. And then we'll be looking at 18th December. Right. So you can see here, remember the Fed only started to cut rates on 18th of September, 7th of November, and 19th of December. And I guess many of you can already spot by now, right? While the Fed was cutting rates, the dollar index actually reversed course and started to climb higher, right? And similarly, before the Fed embarked on a rate cutting cycle, the dollar index was already losing its value well before that, and it started to fall as early as July, right? So this is what I mean by rate cut expectations, right? Remember, markets are always forward looking, right? They're not going to wait for the interest rate decision to be made. They're going to wait for Chairman Powell to make a speech or make his comments, his press conference. Markets are always going to be moving well ahead of that interest rate decision. So we can see here, during this period, which is the third quarter of 2024, between July and September, the dollar index had already started to fall rapidly, right? We can see the dollar index going from peak to trough, had dropped as much as 5.6%, right, over this period, losing easily 600 pips over this period here. Now, why did it happen? Remember, it all goes back to key macroeconomic data, which was inflation and labor market. During this period, which was the third quarter of 2024, we saw inflationary pressures start to decelerate, right? We saw headline CPI start to decelerate. And at the same time, we also started to see non-farm payrolls start to report slower job growth. So when you have a slower labor market and you have inflationary pressures dissipating quite strongly, it gives the Fed impetus to begin cutting rates, right? Remember, at this point, the Fed has not even started to cut rates, but they're just thinking about cutting rates, and that raises interest rates, rate cut expectations, and that's going to cause people to sell the dollar well before the Fed actually made its first rate cut. So going back to the slides, right? If you quickly go back to the slides here, right? We can see from April till September, headline CPI was decelerating quite sharply. And at the same time, from May to October, we saw the non-farm payrolls report poor job growth, right? This was very weak job growth relative to what we saw in 2022 and 2023. So we had a slower labor market, and we saw inflationary pressures dissipating quite strongly, all leading to rate cut expectations building up very strongly. So, in fact, the dollar index was already falling rapidly well before the first rate cut. Now, the first rate cut took place on 18th of September. Dollar index dropped a little bit lower, hitting about 100.13. But what happened from October onwards, we saw demand for the dollar pick up rapidly, right? So you might think this is counterintuitive, right? The Fed on 18th of September makes a jumbo rate cut of 50 basis points, and you would think the dollar index is or would likely to get weaker, even would is expected to get even weaker following a 50 basis point reduction. But what actually happened? The dollar index did slide a little bit lower, but it sort of consolidated around 100.30 and made a very strong bullish reversal to climb strongly. Now, why did it happen? That brings us back to the key US macroeconomic data, which is, in the current context, CPI, inflation, and the labor market. So if we look at the labor market, as we look at inflation first, CPI, core inflation remained relatively stable in the final quarter of 2024, right? This is Q4 2024. And at the same time, we saw inflationary pressures accelerate as well. We saw headline CPI accelerate from 2.4% in September all the way to 3% in January, while core CPI continued to remain persistently sticky at around 3.2, 3.3%. And during the same period, we saw non-farm payrolls start to re-accelerate, right? We saw ADP report continue to indicate steady job growth for the private sector, but non-farm payrolls showed a very strong rebound, especially for November and December. So we have a period in the last quarter of 2024 where we saw inflationary pressures start to accelerate, and we see the labor market make a rebound, all of which is going to put doubts on the Fed for future rate cuts. Remember, the Fed had already penciled in or forecasted 3 rate cuts for 2024, and that's what they did. Right, that's what they did in 2024. But as the economic data evolved and changed in the final quarter of 2024, it completely changed their outlook for 2025. So that is why, right, we can see here. Let's create a new box. Right, and let's call this, right, and this second box is going to be, and this second box is the last final quarter of 2024. So during this period, even though the Fed continued to make 2 more rate cuts, right? They made a 25 basis point reduction on 7th of November, and they made another 25 basis point reduction on 18th of December. The value of the dollar index actually started to climb even higher, right? Imagine if you're just trading interest rates, central bank decisions blindly. You see, the Fed made a 50 basis point reduction on 18th September. I'm going to short on the dollar index. Or conversely, you could go long on the euro, right? Let's look at the same dates. Oh, sorry, this is, yep, here we go, September, 18th September, 7th November, and 18th December. Right, so you can see here, right, the euro actually started to fall. Euro USD started to fall. So that means demand for the dollar was picking up as the Fed was cutting interest rates, and the most profitable trade was not to go long Euro USD, but to go short Euro USD. Similarly, during this period when the Fed was cutting rates, the most profitable direction was not to be short on the dollar index, but actually to be long. Why? Because we saw inflationary pressures start to reaccelerate. We saw the US jobs market rebound, right? So you can see here, if we had just decided to short here, right, following the first rate cut, right, we may have made a little bit of money. Now, if you had decided to short on this second rate cut, maybe on that day itself, right, we may be able to capture something on the short trades. But you can see the price rebound very strongly once again, even on 18th of December, right? We can see the dollar index pulling back slightly, but we then see it resume the uptrend, right? So you can see here how the macroeconomic data is important to monitor because it really drives the direction for the particular currencies, and markets are always forward looking, right? If you're waiting for the central bank decision to actually take place, you're probably too late to the game, and you may even take the wrong trade direction. And now we could combine all of this with the technicals as well. Now, very clearly, we can see the dollar index in the third quarter of 2024 trading in a prolonged downtrend. And we clearly see a series of lower highs, lower lows, and in fact, there may have even been a pretty nice downward channel, right, to identify, right? There's a nice downward channel here, right? Not the most perfect downward channel, but generally you can see that dollar index was trading within this channel. And then after the first jumbo rate cut took place, we can see, let me just get rid of, I'm not going to move this slightly here. We can see that the dollar index actually made a bullish break out of this downward channel. So not only did we see inflationary pressures start to accelerate, and we saw the labor market rebound in the final quarter of 2024, we actually saw a very significant reversal materialize as well. We saw the dollar index break out of a prolonged downward structure, making a bearish breakout. And that bearish breakout really did lead to a very strong rebound, right? This was a very strong rebound here. So it's also important to take note of key structures, market structures, and when those market structures get broken, it really can signify a strong move to the other direction. And when it's driven by macroeconomic data, when it's driven by fundamentals, it's really going to see a huge move as well. So imagine here the first rate cut of 50 basis points takes place, but you're not aware of the macroeconomic data, and you're not aware or you didn't realize that the dollar index actually now is breaking out of this downward structure, and we continue to short the dollar index. This would have resulted in a very unprofitable outcome. Similarly, for the Euro USD, 18 December, right prior to that, the Euro was trading. Okay, not the best channel, not the best upward channel. Let me see if I can try and capture a pretty decent upward channel here. Right, there's a very nice upward channel for the Euro from pretty much July till September. But once price broke out of the upward channel, right, it signifies a key shift in momentum, a key shift in direction. And then after that, we really saw the euro fall rapidly, right? In this case here, when the euro is falling rapidly, it means the value of the euro is low, the US dollar is getting stronger, right? So you can see here drop here. So with each subsequent rate cut, the US dollar did not get weaker. The US dollar actually got stronger, driving this currency pair, Euro USD, all the way down to as low as 1.017. So if you look at it, since its peak in September of January last year, September of last year till mid-January of this year, the euro had lost well over 9%, dropping nearly 1,000 pips over the process. Right. Similarly, dollar index from its peak or lowest point in end of September all the way till mid-Jan, the dollar index rose well over 10%, rising nearly about 10,000 pips here. Right. You can see here a huge move in either direction. Right. So that's why it's important to understand how we're going to combine technical analysis, combine uh, the evolution of macroeconomic data, particularly US CPI and the labor market, and then how that's going to drive the direction for the value of the dollar index here. Right, so was a very this is quite important to take note of as well. Now let's go on to dollar yen. Right, dollar yen is important as well. Let's remember I talked about central bank intervention and monetary policy divergence as well. So let's go back and do a little bit of a case study for that. So let's go back to 2022. So 2022, March was when the Fed, I can't remember exactly. Okay, let's go back to 2022. Do they have it here? Yeah, 2022, March 16 was when the Fed made the first rate hike. Remember, this was back in 2022. So here, right, we can see during this period in the first half of or from March till October of 2022, this was a period, right, where we had monetary policy divergence. between the Federal Reserve and the Bank of Japan. So that means during this period, the Fed was raising rates aggressively while the Bank of Japan kept its key policy rate at negative 0.1%. So when you have such a scenario, central bank A, the Fed raising rates aggressively, it means the value of the dollar is likely to increase strongly. And at the same time, when Bank of Japan keeps its policy rate at negative 0.1%, it means the value of the Japanese yen is going to be very weak. And what we saw is a sharp acceleration for the dollar yen, where it rose nearly 30%, right? It jumped 30% in a matter of 8 months, right? So you can see here how monetary policy divergence can create a very strong fundamental catalyst for the direction of the currency pair that is involved. And in this case, this is the dollar yen. Of course, price never moves up in a straight line, right? Price never moves up in a straight line. There's always pullbacks along the way. But once we know the overall trend, and once also price breaks out of certain structures, which I'm going to highlight here, we can see that the moves continue very sharply. For example, during this correction here for the dollar yen, this was a nice downward channel. And this was a nice downward channel. And then we can see dollar yen stabilizing at around 126.5 during this period. And we are also able to use Fibonacci retracements. And we can see in this case, the dollar yen stabilizing around the 23.6% Fibonacci retracement, stabilizing just above the green Ichimoku cloud as well. And then as it makes this break out of the downward structure, we can see the dollar yen accelerate sharply once again, right? Because this is all in the backdrop, right? On the backdrop of monetary policy divergence between the dollar, US dollar, and between monetary policy divergence between the Federal Reserve and the Bank of Japan. And we can see dollar yen jumping another 8.5%, right? Rising another rising another easily 1,000 pips once again. Right, even here a very sharp pullback. Very sharp pullback is finally causes dollar yen to stabilize before breaking higher again. Now in this case, there's a new Fibonacci retracement that probably needs to be drawn. A couple of retracements here. You have one which is here, 23.38, and then we have another retracement that can be drawn from this low to this high here. And in this case, this should be the 50% retracement. Right? Oh no, it's not 50. Let's go. This is 61. So you can see here, as the dollar yen was retracing or pulling back strongly, by July it found support at the 61.8% Fibonacci retracement. Not only did it find support at the 50%, 61.8 Fibonacci retracement, it found support at an overlap support area as well. You can see here, this level at 131.47 previously was a swing high resistance, which functioned as support in June, and it functioned as support once more in August. So this creates a very nice overlap. Then this price bounces off this key overlap level, accompanied by the Fibonacci retracement at 61.8%, and then it makes the bullish breakout. You can see dollar yen jump another 12% as well, rising, making almost 1,600 pips. Right? This is all given the backdrop of monetary policy divergence between the US and Bank of Japan. Now, something changed rapidly in the final quarter of 2022. What happened here was, remember, central bank intervention. Now, during this period, right, which is between October 2022 and February of 2023. During this period, the Fed still continued to raise rates aggressively. Remember, the Fed was still hiking rates aggressively, but the Bank of Japan was actually engaging in intervention, right? They were engaging in intervention measures. That means they were selling the US dollar, buying back the Japanese yen. Now, if you're not aware of this operation that was taking place, and because we thought, oh, the Fed is still raising rates aggressively, that means dollar yen is going to go higher, right? Dollar yen is going to continue to climb higher. But no, in fact, dollar yen reverse course sharply, dropping as much as 60%, losing nearly 2,400 pips. So you can see here why it's important to be aware of what major central banks are doing, because when the Bank of Japan engages in intervention measures, it really can drive the currency pair in the opposite direction. Remember, during this period, the Federal Reserve was still raising rates aggressively, but the fact that the Bank of Japan was acting even more aggressively via intervention measures that caused the dollar yen to fall rapidly. And then what happened was in February was when the intervention measures had stopped, right? The Bank of Japan had ceased its intervention measures and normal market operations resumed. And when normal market operations resume, it brings us back to monetary policy divergence because during this period now, between Feb between Feb and July of 2023. This is where the Fed continued to raise rates while the Bank of Japan kept its rates at negative 0.1% over this period. And we can see key technical levels being broken, key technical structures being broken, right? We can see dollar yen make like a double bottom before finally breaking out of the downward structure and making a very sharp rebound, climbing as high as 5.2%. Now, during this period here in March of 2023, we had dollar yen pull back sharply. This was because of the regional banking scare, right? There was a regional banking scare in the US, which led to recessionary fears. And when we have recessionary fears, right, the currency pair, the Japanese yen, and the Swiss franc are typically safe haven assets. And that means as investors buy the Japanese yen aggressively, that causes the currency pair dollar yen to pull back. But then that situation, right, the banking crisis, the regional banking crisis, so to speak, was resolved by the end of March, early April, and then we see volatility being removed from the market, and we see monetary policy divergence continue to take place. Right, you can see here the financial banking crisis is resolved, or the regional banking crisis in the US is resolved, and during this period, the Fed is still raising rates aggressively while Bank of Japan is keeping rates at negative 0.1%. And we can see dollar yen jump as much as 10%, rising nearly 1,300 bips. Right. So you can see here when you put it all together, when you put interest rate decisions together, intervention measures, monetary policy divergence, as well as you overlay with key technical analysis, and you see markets break out of key structures, right? We can see that it really leads to very strong moves. Even here, this correction here for dollar yen at the end of March, right? Remember, safe haven demand increases, demand for the Japanese yen increases. That means the currency pair dollar yen is going to fall rapidly. And then as the crisis is resolved, volatility recedes from the market, overall sentiment improves, and then we can see normal market operations resume once again, and we see dollar yen rising very sharply. Even here, July 2023, there was suspected intervention measures here, but once price breaks out of this downward structure, you can see dollar yen accelerate very sharply once more, making 10%. And here at end of November as well, there was suspected intervention measures here as well. But once again, once you see key market structures being broken, right? This was a prolonged downward channel, and then you see a bullish break for dollar yen. And you can see once the bullish break materialized, dollar yen rose as much as 5% by February of last year, before finally going up as high as rising as much as 11%. So you can see here, right? Identifying key market structures, corrections on downward channels, and then identifying the breakout point really leads to strong rebounds and reversals as well. Right, this was another strong move where dollar yen rebounded 6.2%, jumping nearly 1,000 pips over the process here. Right, okay, let's see. Okay, as we are towards the end of today's webinar, right, are there any questions regards to what we've covered so far? I'd be more than happy to answer your queries. And before we wrap things up, I'm going to launch a poll as well. Truly appreciate it if you guys could give your feedback with regards to today's webinar. And we can continue with a few questions as well. I'll be more than happy to answer your queries as we wrap up today's session. All right, I think that's most of you have voted. All right, truly appreciate it. I'll keep the poll running for another 20 seconds or so. All right, great. I think that's all of you. All right, truly appreciate it, guys. All right, if there are no and further questions, then let's just call it a wrap. All right, once again, thanks for tuning in to today's session brought to you by IronFX. And I look forward to seeing all of you at the next session. Right, take note, we've got another session tomorrow at the same time on Thursday. I believe it's going to be live, it's live trading or breaking news. So do tune in for that session tomorrow at the same time as well. All right, thanks everyone. Take care. Have a great trading week and catch you all at the next session.